Hi, and welcome back. Thanks for joining me in my continuing discussion on corporations. I want to slide in a quick presentation here on where we are on our balance sheets for corporations as far as they relate to the Stockholders Equity section. Our balance sheet equation has changed to be assets equals liabilities plus stockholders' equity. Although I'm going to use up a bit more of the page than just under the Stockholders Equity section, all of this relates to what would show up here. There are two main sections to the Stockholders Equity section, though I'm going to sneakily add a third in Chapter 16. Don't worry about that yet. Right now we have paid-in capital and retained earnings. In paid-in capital, we show money paid in by our stockholders, and retained earnings is money that we have made that haven't paid out in dividends. Let's assume I have two kinds of stock, both preferred and common. I have preferred stock, and it's shown first. This part of the balance sheet is shown in order of non-permanence, and preferred stock can come and go. Common stock must stay, so preferred stock is generally shown first. Notice it says I have $100 of par value stock, 50,000 shares are authorized, and 1,000 shares are issued and outstanding. That means my par value is $100, and I have sold 1,000 shares of these, and they are still outstanding. Nothing has been purchased and held in the treasury. I added another line. I added the paid-in capital that relates to the preferred stock. Paid-in capital in excess of par from the preferred stock that I issued, those 1,000 shares, is 50,000. So you know that I've issued that preferred stock for a total of $150,000. Next comes my common stock. $1 par value, 10 million shares were authorized by my corporate charter, and 2 million are currently been issued and they're still outstanding. And I would have 2 million times $1 par value in there as a result of that transaction. The next line says I have paid-in capital in excess of par from common stock transactions of 5 million. Now you know that I've sold my common stock for 2,500,000. 2 million of par, 500,000 above and beyond par. My total paid-in capital from all sources equals 2,650,000. Some of it's from preferred stock, and some of it's from common stock. And this is how much has been paid in from my owners. Next would come retained earnings. In my example, I'm going to say the amount of retained earnings I've had put in over the years equals $10 million. Let's review what retained earnings is. Retained earnings is an account. It's a new account. It's particular to corporations. And it's where we close net income into. So it holds all of our net income since we've been in business, minus all of our dividends paid since we've been in business, from the beginning of time to date. And that's what's in retained earnings. So our total stockholders' equity on my balance sheet would equal 12,650,000 total stockholders' equity. And I would have assets and liabilities that would balance that out. That tells you where we are. Now I want to do one quick thing and show you some closing entries for a corporation. Unscheduled, impromptu. Deal with it. 1, you still close revenues. And revenues get closed into income summary. So you're going to debit revenues and credit income summary. And it would list all your revenues out, as you always have done. And then you would close your expenses. Expenses have debit balances, so you would credit them. So we'll debit income summary for their total of our expenses, and then we'll list out our expenses individually and close them. So into income summary, you put revenue and expenses. If I'm not mistaken, that leaves net income in income summary. Now it's time to close income summary. Income summary gets its net income. It's going to have a credit balance, so we'll debit it. We'll debit income summary. And for a sole proprietor, we put it in capital. And for partners, we put it in several capitals. But for corporations, we put it in a new account called retained earnings. Wahoo! Look at that. The closing entry changed a little bit. As far as the fourth closing entry goes, closing draws doesn't apply to corporations. It applies to sole proprietors, and it applies to partners, but it doesn't apply to corporations. Our book has you record dividends when paid to stockholders directly into retained earnings, so there is no fourth closing entry for corporations. Close revenues, close expenses, and close income summary. And income summary gets closed into retained earnings. And it gets closed into there every year that you've been in business, and dividends get taken out. So if you've been in business 2 years, your balance in retained earnings would show 2 years of net income minus 2 years of dividends. Work hard to understand what that is. It merely replaces the owner's capital account as far as net income goes. Not so bad. Thanks for joining me. Just wanted to take a minute and make sure we're solid on the balance sheet for corporations. Let's move on.